Okay, well maybe we'll make a start. Thank you very much indeed for sparing the time on a Thursday afternoon to come along to the last in our current series of insurance masterclasses. These have been going on now for the past couple of months sporadically, covering off most of the sort of PI and specialty classes. And I hope those of you that have come along to previous sessions have found them of use. This is as I say, the last in the series, and the intention after today, I think, is to send out some sort of follow-up materials. I think we may be sending recordings of the sessions and any sort of slides and whatever. So you will get all of that after today. We've kept the slides sort of quite brief, so we haven't got a sort of a script as such. In fact, we're sort of trying our best to give this masterclass the feel of a sort of an informal presentation rather than anything more formal, more of a discussion. So I'm joined today by Amanda Norton, who is our in-house head of risk and compliance. But Amanda is also ex-SRA, and so comes at the role with a different perspective, poacher turned gamekeeper, you could say. So the hope is that over the course of the next sort of 40 minutes or so, Amanda and I will go through some of the pressures that exist on the legal profession, both from a regulatory and a civil perspective, look where those pressures manifest themselves inside the minimum terms, and then sort of try and project forward perhaps what that might look like going into the future and where Solicitors PI might be heading. So that's a sort of an overview of where we're looking to get to. But I guess first of all, we thought it would be a good place to start to just recap on how we've got to where we are now, and how the minimum terms have sort of evolved over the past 21 years since they were first introduced back in 2000. And I think that the main sort of golden thread that permeates through all of Solicitors PI right since 2000 and before, when things were dealt with by SIF, is this concept of consumer protection, which, you know, but back then was probably quite new, but now seems to be a phrase that we hear everywhere, and to a large extent rightly so. And the essence of obviously consumer protection is to make sure that those who consume, in this case legal services, are at all times safeguarded from things going wrong. And the minimum terms were designed with that very much in mind, and you could say that they were designed to protect the consumer more than they were designed to protect the solicitor. And so to that extent, the minimum terms have always contained gilt-edged cover for the professional, but ultimately for the benefit of the consumer. And we'll talk in a little while about some of the quirks of the minimum terms and how the extent of cover has sort of broadened out over the years. But I think it's important to note that when the minimum terms first came in, it was right in the heart of a soft market, and that soft market has kept prices low across the board right through from 2000 or possibly before to, I mean, you could say 2018 probably. So the vast majority of the life of open market Solicitors PI has been within the confines of a soft market. And so this gilt-edged cover that is, you know, tremendously valuable has been available at, you know, bargain prices, one would say, throughout the vast majority of that sort of ensuing 21 years. And at any point in which there has been any whispering at all of the market hardening and prices going up, we've had various people within the SRA, and you may recall, those of you that have been in Solicitors PI for a little while, delightful man by the name of Crispin Passmore, who, among others, have tried to introduce various measures over the period of time to keep prices low. So famously, the SRA introduced subprime insurers into Solicitors PI and passported them in from all other areas of Europe. So we had Quinn, Lemma, Balva and others coming in and offering very, very cheap PI for solicitors. All of them went spectacularly wrong, I think, and effectively ran out of money long before the policies expired and left solicitors high and dry. But the idea was that the introduction of bargain basement solicitors PI would keep the rest of the market honest and keep the prices down. And when that had run its course, we had then had the infamous £500,000 limit of indemnity that was proposed, or a 3-year run-off period being proposed as an alternative to what exists at the moment. Again, just trying to keep those prices down. But now, following the Lloyd's review in 2018, where there was a sort of wide-ranging reduction in capacity for PI because it was deemed to be a non-performing class, and that then in turn creating the hard market that we're right in the thrust of now, we are in a period where some firms are now sort of struggling to pay what are for them the highest rates that they've ever been asked to pay in their careers, and as a result, very sadly, some firms are having to fold. And so that's where there is now this mounting pressure on the SRA to react, hopefully by considering which bits of the minimum terms they really need, whether the consumer needs to be protected to quite the extent that it is being protected currently, and really just to try and keep the profession sort of going as a viable ongoing concern. But it's not just pressures that have been caused by market movement that have got us to this point where the cost of PI is so high. Claims activity, we know, has gone up markedly over the last few years, and that will be the subject of an entirely separate talk, and be delighted to talk about claims trends and all of those kinds of things separately if anybody wants that to be provided. But you know, we all know that claims against solicitors are very much on the rise. But a thing that you might be sort of slightly less aware of, because it's crept up slightly, you know, without necessarily hitting the headlines, is the regulatory side. And so, you know, I thought, Amanda, maybe you could just sort of give us an overview of where the SRA side of things sits from a regulatory perspective at the moment.
Yeah, so what you're looking at there is a picture of my former offices, so the Cube. So sort of look back at that with a certain amount of fondness, but it's interesting now being on the other side of the fence, as Joe was saying earlier. You know, poacher turned gamekeeper, whichever way around that phrase goes, thinking about the extent to which the regulatory environment has moved. So I was at the SRA from its inception, but I'd been there previously when the sort of regulatory function that I worked in was part of the Law Society. We moved from being based in Leamington into the centre of Birmingham. And over that period of time, I think the sort of regulatory landscape has transformed from being primarily focused on individual solicitors and their sort of professional conduct. And at the time that I joined, which is back in the late 90s, the focus was very much around you know, issues with client account, stealing client money, those sorts of things which continue to this day. But at that time, we were just starting to be dealing with issues around money laundering and mortgage fraud, so sort of broadening out from the pure sort of conduct and the dealing with the client monies to a wider range of activities. And that trend has only continued as the sort of regulatory environment has crept and has increased. So the SRA is now dealing not just with issues, as I say, around sort of pure solicitors' conduct and misconduct issues, but is dealing with other regulatory issues that have sort of been imposed on the legal sector, and which the SRA is now expected by virtue of various statutes to be involved. So I'm thinking particularly around money laundering, where there's now, you know, statutory requirements for lawyers to comply with money laundering regulations. That comes down at from a high political level through various of the supervisors and including the SRA, and that sort of political impetus has been obviously increased more recently with the introduction of OPBAS as a sort of overseer of all the supervisors under the regulations. But there are various other areas as well. So, for example, the sort of more recent transparency requirements, those have come in as a result of other sort of market thinking that the profession needs to be more transparent in terms of its operation. So again, that's something that's driven from outside the SRA, but the SRA has had to react to. So I think the regulator is still dealing with the core and the core activity that it has always dealt with. What I'm sort of talking about as the sort of basic sort of professional conduct issues, but is expanding, as I said, to deal with other sort of more external factors, and also with a shift in cultural expectations as well. So starting to look much more closely at issues around sort of things that happen outside of a solicitor's professional life. So recently somebody was struck off, for example, for misusing a blue parking badge. The SRA has always looked at certain elements of conduct outside of the professional office life, if you like, such as drink driving, but is increasingly involving itself in other personal life activities where there is a sort of a direct link through to their professional status as a solicitor. So, for example, misuse of social media, anything involving honesty and integrity issues outside of a professional life, a whole variety of things, so many of them now it seems, including of course the sort of sexual misconduct issues, which previously probably the SRA would have regarded as an employment sort of issue, but increasingly has become involved with, and I think partly that's as a result of sort of outside pressure as well, which sort of leads to that change in sort of cultural regard as to what is appropriate or inappropriate behaviour and who should be dealing with it. So I think increasingly the SRA is becoming involved in a much wider landscape than it was certainly when I joined them back in the late 90s.
And I guess that's relevant then, Amanda, from a PI perspective, because as you say, the disciplinary side of things is definitely on the increase, and an element of cover for disciplinary activities is included within the minimum terms, or insofar as it isn't, is offered as either as a no cost extension or as a very low cost extension to most firms' policies. But then I guess the bigger one in many ways is that it used to be the case, and I too started in the late 90s, and it used to be the case that the courts dictated what the scope of a lawyer's or any professional's duty was. And so if you wanted to find out how broad a duty was, you looked in the statute, the statute books or the law reports. Whereas now there's been a real shift, it feels, and certainly over the last 10 years, probably at least, it feels as if the regulators now lead and the courts follow. So the extent of a lawyer's duty now is very much dictated by what the SRA say. And certainly I have lots of lawyers' liability cases where the claimant is looking to establish a duty on the part of the solicitor, not by reference to a case or a statute, but by reference to what the SRA has said in its standards and rules and regulations and its various sort of codifications. So their role is really, really front and centre now, isn't it?
Yeah, I think that perhaps is representative, if you like, of a sort of shift in attitude as well. So a move away from a sort of reactive regulatory position where something might happen and the SRA would decide whether or not to take action, to much more proactive. So a big increase in the sort of proactive supervisory activity, which perhaps evidenced now best through some of the thematic work that the SRA is doing.
Yeah,
but also a willingness to sort of get out there and lead the way in terms of what a regulator should be doing. And as I was saying, I do think that some of that stems from sort of external pressures that are perhaps placed placed on the SRA now in a way that might not have been quite so evident before. And I think some of that is probably technology driven in the way that we're all impacted by, for example, the ease with which themes can arise and come to the fore through campaigning on social media, etc., etc. So I think it's probably exemplified by the environment that we're all operating in now, in that things come to the fore a lot quicker, and there's an expectation, I think, that any regulator probably is reactive to that in some ways, but the SRA is also being proactive in taking those things forward before perhaps issues have gone to the courts.
I dealt with thematic reviews back in the late 90s in the context of financial advisors and the FCA, or the FSA as I think it was then, but it was that produced all manner of claims and problems when the regulators started looking at things in a thematic way. Do you think that could actually end up happening within the SRA? I haven't seen it happening yet.
I think it could do if a thematic review effectively sort of turns itself into guidance as a result. And I think there are some sort of examples. So, for example, there was thematic review done around sort of investment handling, I think, which then sort of led to advice. There've been some around money laundering that have led to the sort of results being published that indicate areas where firms are commonly falling down. And I think the inference from that is that you're sort of almost expected to read that, see where firms are commonly failing, and make sure that you're addressing them yourself as a firm.
And of course, I guess anything the SRA throws out by way of conclusions from a thematic review is going to be picked up on by any claimant solicitor that's got a claim that's related to that in any way, and almost used as evidence against you, isn't it?
It easily could be, I think, and I think that's what makes it quite difficult for firms to make sure that they're keeping up to date with everything, because there is a wealth of material coming out, and in a way that never used to.
You showed me yesterday when we were chatting about this the risk cards that used to come out in the Law Society Gazette, which
yes, I have them. I don't know if anyone on the call is old enough to remember these. But before the internet, this is how messages were got out there. So these sort of laminated cards were sort of popped inside the Gazette and then distributed, and you were expected then to have been made aware of them and therefore to take on board the messaging. But I was reflecting, looking at some of these, which I found the other day, on the fact that a lot of the things, while it feels like the regulatory landscape is expanding, a lot of the things that are out there really have been out there forever and probably remain out there for some time. So things like investment warnings, there's just been a recent investment warning put out by the SRA, but effectively it's the same sort of thing as was happening, back in the 90s and through time. Things like some of the scandals that probably hit the insurance world or led to the insurance world sort of coming into being in the past. The same sort of schemes still take place. But I was amused to look at this one, because one of the fraud indicators apparently was proposals being received by fax. And I thought, if that happened now, you really would be quite alarmed, wouldn't you? If you actually had a fax machine still in your office.
Still plugged in. Yeah, absolutely. Absolutely. Yeah. But I think you're right. I think that everything goes in cycles, doesn't it? And the market is very much an example of that. But we do seem to be in a bit of the perfect storm at the moment for problems, because the SRA do seem to be in one of those phases where they've just reintroduced the latest version of their rule book, as they did before it came out. When it came out, it was very, very small, but it's being added to in its droves by practice notes and guidance notes and all sorts of other things that are expected to sit alongside it. And they just seem to have found their teeth, I think, don't they, over the last few years, in a way that perhaps before that they were a little bit of a toothless regulator, or at least they were not as well resourced perhaps as they are now. I don't know.
I think they've expanded their operations in certain areas, and AML is a really good example of that, because they've invested in a whole new team to go out there and proactively look at solicitors' sort of AML or anti-money laundering activity. I suppose I was bound to argue that they did have teeth before. I mean, people have been taken to the tribunal and disciplined and investigated, etc. You know, for, well, certainly since the late 90s, and I think the investigating team was set up sort of post Second World War at the Law Society, because particularly because of the, you know, client money that firms hold. You know, there's temptation there. Some solicitors are dishonest, some just get tempted by circumstance. So to a certain extent, that's probably sort of cyclical, in line with the economy. I think it'll be interesting to see what happens if interest rates start to rise. You know, what happens in terms of sort of financial issues within law firms themselves, but B, the link that has been evidenced in the past by work that the SRA's done between financial difficulty and dishonesty or misuse of client money. So I think it'd be interesting to see going forward.
Yeah, well, I agree.
What happens.
Well, I think, I mean, we're going to come on, aren't we, in sort of right at the end, to talk about where the future, you know, what might happen in the future. I thought it might be a good idea to just go on quickly and talk about, you know, having sort of looked at where the regulatory pressure now exists and on firms, and obviously that we didn't even cover off the fact that we need all our compliance officers for legal practice, financial side of things as well, and for small firms that really does put a huge burden on. But in terms of the burden that then that places on the minimum terms itself, you know, there are various bits within the minimum terms that make it the sort of the gilt-edged cover that it is. You know, obviously very limited exclusions, that sort of pay first, reclaim against the insured later if they've breached their policy requirements, the run-off provisions, which don't seem to exist in many other classes of business as far as I can see, the fact that excesses are payable by insurers if the insured can't pay. All of those things add to the, you know, the burden that insurers of solicitors have to carry. And obviously we've known about those for ages, but, you know, as you rightly said there, Amanda, the regulatory burden wasn't necessarily anticipated when the minimum terms were drafted, and I would say that the way in which the regulatory side of solicitors PI cover is dealt with is up for review, because I do think that regulatory issues are going to only get more and more significant with time, and in any insurance environment which is largely drafted or based around civil liability and the courts, you know, I think we're probably going to need to look at that in future years, because a large part of the liabilities of lawyers will be from the regulatory side going forward, not necessarily always from the civil court side. But there are other unintended consequences of the minimum terms as well. I've seen, and I'm sure that some of you on the call now will have seen examples, quite a few examples of the runoff cover being almost used as a form of retirement planning for firms, as a way of sort of cheap, sometimes free even, retirement planning, because as there's no adjustment to the levels of cover if the premium goes unpaid, it is possible, and I've seen it on a few occasions, and I'm sure you have too, to get the benefit of that runoff cover without actually paying anything for it. And in circumstances where the vast majority of firms that call upon the runoff cover are distressed in some way, a large number seem to be unable to afford that cover when the bill goes out to pay for it. So those are some unintended consequences of the current version of the minimum terms. Friday afternoon fraud is another one. Again, that is something that it seems to me to be impossible to rate that risk on a firm by firm basis, because it isn't based in any way on the abilities of the lawyers within the firm or the systems and processes that they have in place on the legal work, but entirely to do with their IT systems and the quality of some of the back office staff, and that hasn't been a big factor on most presentations and prop forms in the past, and huge losses have flowed because of that being a breach of the solicitor's accounts rules, and then the cover being triggered. So that's another unintended consequence. And the latest one is aggregation, where back in 2005, when the SRA moved the limit from 1 million each and every claim to 3 million each and every claim, still not allowing aggregate limits, the insurance market sort of was up in arms about that and said, well, the only way we're going to agree to do that is if we can aggregate very readily, so as to avoid a potentially open-ended exposure. And that was agreed by the SRA. The current wording was agreed. And in the recent case of Dixon, Coles and Gill, the court has basically ridden roughshod through that and not allowed insurers to aggregate all of the actions of a fraudulent rogue partner in circumstances where it seemed to me that was the kind of situation that was being anticipated and was trying to be dealt with when the wording was changed back in 2005. So again, another sort of unintended consequence of the current drafting of the minimum terms, and another way in which the pressure is mounting on those terms to be reviewed. And I know there's been a lot of call within the market from the LMA and other organisations on the SRA to do a bit of a revision of where things stand. But so far, certainly as far as I'm aware, that has fallen on deaf ears, and we are where we are. And not only are we where we are in terms of the current wording of the minimum terms, but now we're having to cope with the introduction of affirmative or non-affirmative cyber cover, which again we've still got no real clarity around, despite the original deadline having been the 1st of January this year by Lloyd's and the PRA. But it seems as if the wording will be changed as of the 1st of April next year to positively affirm that any cyber issue arising within a firm will be covered under the minimum terms insofar as it relates to civil liability. So third-party cover will be afforded, but there will be no first-party cover, so the firms themselves will have no cover. Handy from the SRA's perspective, because that's consistent with their consumer protection mantra, but it causes, I think, or it has the potential to cause an awful lot of confusion on a practical level, because a lot of firms will buy cyber cover as a result. The cyber cover that they will buy will probably have third-party cover in it as well, so the potential for double insurance will be there. The potential for policy coverage disputes over which of those two policies ought properly to respond will be there, and in circumstances where primary 3 million cover on the PI side is now quite frequently being done on a split basis with more than one insurer taking that 3 million primary layer, the potential for insurer heated discussions I think is very much there. And I think there's also going to be a pricing issue, because a lot of insurers, I think, will look at the incident response, the crisis management aspects of cyber cover and view those as a real benefit to any firm that carries cyber. And they may well think that those firms are more attractive as a result. And so insofar as preferential terms are available in the current market, those firms may well get them, whereas those firms that don't carry cyber cover may struggle. And in circumstances where they're struggling anyway, that could put firms out of business. So again, I think it's one of those where we'll have to see what happens. But I think an opportunity to review the minimum terms in a more wholesale way has been missed here, personally. And I think we all collectively ought to be doing as much as we possibly can to put as much pressure onto the SRA as we can to just revisit the situation and maybe sort of redress the balance between consumer and professional, which I certainly feel has perhaps gone too far the other way. Sorry,
Joe,
Amanda.
just before you go, it's all right. Just before you go on, somebody's just asked whether you can give details of that aggregation case again, please.
Yes, I can. It's called Dixon, Coles and Gill. It was the Court of Appeal decision was probably only 6 or 8 weeks ago. What I can do after the session is I can forward that as a link around to anybody that's interested. You know, it could accompany the slides, so you can have a little look at it. But it's an interesting case. It's a very interesting. Well, it's interesting in terms of the facts as well. Very sad, yeah, happy to talk about that sort of separately. Did you have anything else to add to that, Amanda, before we sort of go on to the sort of the final part of the session?
Yeah, the only thing I was going to reflect on was when you were talking about you know, the requirement for runoff cover. I know that gives the SRA some issues sometimes if people effectively stay in practice longer than perhaps they sensibly should do, because they feel that they can't afford it. So in other words, they keep on trading when really probably they should retire. So sort of various sort of potential competence and supervision issues arise out of that sometimes. So I know that's an issue for the regulator as well.
Definitely.
As well as
and obviously that puts pressure on the compensation fund as well, because in the circumstances you've just described, where you've got a firm trading without PI cover, then the runoff provisions arguably won't be triggered, because they only cover historic work undertaken before the extended indemnity period is finished. So if they're carrying on trading into the future, there is no effective PI cover at all, isn't there? And so that, again, that's a compensation fund issue, which that's under an awful lot of pressure as well.
Well, the cases I was thinking of, they may be sort of paying their annual fee, but they don't feel that they can afford the runoff. So they don't stop, if you see what I mean. They keep going.
They keep trading. Yeah,
they keep trading when perhaps they're past their best. Let's put it that way. Yeah.
Very good. Well, the final sort of part of what we were intending to cover was really just to try and look into the future and work out sort of where future claims are going to come from a civil perspective, where they're going to come from a regulatory perspective, and perhaps to give a view as to how that might well impact you in terms of how you then are broking and rating solicitors as a risk going forward. So, I mean, no talk is complete these days, is it, without mention of COVID, sadly. But we do anticipate a bit of a spike of COVID-induced claims, whether that's arising from a lack of supervision whilst we've been in lockdown, or that sort of experience gap that seems to exist, where people just haven't had the right level of supervision and experience and training, or the same level that they would have had we all been in the office. Or whether it's in a particular area. Conveyancing is the obvious one, where they've had a real spike of activity as a result of the SDLT holiday and issues around that. Wills and probate, from just not having been able to get into care homes and various other places to see clients, and that giving rise to the ability of unscrupulous family members to challenge wills when people die. Or whether it's just things like insolvency, a greater level of insolvency coming out of COVID, because businesses just not being able to trade out of it, or fraud being the obvious other one. So there is widely predicted to be a spike in claims. I have to say, having spoken to a lot of people around the market, and I don't know what your experience is sort of listening in today, but that hasn't happened yet. So we'll have to see whether it does in fact come. I think it's just being predicted because people can see there's a risk there. Whether that risk is eventuated or not, I guess, remains to be seen. But a couple of other potential civil claim angles, which may or may not have yet hit your radar. One of them is artificial intelligence, where there's a lot being written at the moment about AI and insurtech being the sort of the insurance side of AI. But from a legal perspective, a lot of work is going into automating tasks, automating advice, automating due diligence on M&A transactions, that kind of thing. And one thing that hasn't yet been fully considered, and I think will become more relevant going forward, is the extent to which civil liability will attach to fully artificially intelligent bots or software or whatever it may be, that over time become more front and center of what a law firm does. So I think that's a one to watch. And climate change is another one where we're seeing environmental issues permeate into every angle of what we all do across the board. And insofar as firms are holding themselves out as being environmentally friendly, carbon neutral, whatever, and that turns out not to be the case, and that's been instrumental in them winning pitches or securing work or whatever it may be, then I think greater scrutiny will be paid going forward into people's genuinely green credentials, because it's one of those things that's very easy to say and much more difficult to do. Again, we can see a situation in which claims could arise out of misrepresentation, certainly around that issue. So, I mean, those are the sorts of issues that I was thinking from a civil perspective that may not quite have hit your radars as yet. There's a couple, I think, Amanda, from a regulatory perspective that we were talking about.
Yeah, so first one here is around a sort of trend towards outsourcing of compliance teams, and whether or not that might create problems down the line. I think one of the issues here is that if you outsource your compliance team, how involved do you remain in compliance, and to what extent can you do that, and what would be the regulator's viewpoint on that? I think the thing to say around that is that there's a balance between retaining responsibility for your own compliance and having the expertise and time and resources to do it well. That's always going to be a balance, but I think the key thing is that responsibility, in my mind, certainly would remain with the firm. It's their compliance. They've got to make sure that they're covering off all the requirements. Price transparency, you've popped up there. This is something that is a relatively sort of recent requirement, and the SRA have already done quite a bit of work looking across the profession to see whether or not firms are complying. I think there's been relative sort of, the feeling is that the firms could be doing more, so I suspect that this is an issue that the SRA is going to continue to focus on, because they themselves are under pressure to demonstrate that firms are doing enough. Currently, they've got to focus on review websites, and they want firms to participate more in them in order to demonstrate sort of openness around service and quality standards. And they're looking at the moment, I think, also as to how firms could consistently demonstrate quality as well as sort of price transparency. So I think that's one to watch. Various other things that I think the SRA are likely to be focusing on going forward, things around workplace culture. There have been a number of cases recently at the tribunal where the SRA has put cases forward for the tribunal to consider around particularly junior members of the profession who may have not conducted themselves well, but they have said that is because they've been operating within a toxic culture. So the SRA have indicated that they're likely to be carrying out some thematic work around what is actually a good workplace culture as a way, I think, of probably countering that criticism that they themselves have faced for sort of carrying on and being seen to sort of penalise junior members of the profession who perhaps haven't had the ability to sort of withstand that pressure from within the firms that they're working in. So I would think that's an example perhaps of where the SRA is trying to perhaps take the lead and assist insurers in sort of making it clear what standards they expect. And I think this might be one of the sort of first signs of them really stepping into their sort of entity-based regulator role, as opposed to the sort of individual regulator role that was always the way they operated until, I can't quite remember where, it's 2007, I think, when it sort of started to bring in entity-based regulation. But this seems to me to be a good example of where they may be able to help insurers in terms of saying, well, these are good cultures and this is what we want to promote. They're also going to look possibly at sort of quality of service and supervision, particularly in the immigration sector, because I think they have some concerns about some of the cases that are, and multiple cases that are coming before the courts, where some aspects of the solicitors' sort of conduct are being criticised.
And all of those play through, don't they, Amanda, into potential, certainly complaints,
yeah,
but obviously into
claims
as well, because they will all generate outcomes from the SRA that then will be used as evidence effectively to justify a firm not being up to that correct standard. Yeah.
Another area that they're thinking about looking at is around powers of attorney and executorship within law firms. This is an age-old area that has always been a problem, because with powers of attorney and executorship, those are examples of situations where really the solicitor is probably the only person who knows what's happening within the financial situation for the client. Nobody else really has any awareness, and so it gives the maximum potential for solicitors basically to steal clients' money. Of course, that then leads through to claims and disciplinary proceedings. It always has done, so I don't think there's anything new there. But it's interesting to me that the SRA are saying that they may do some thematic work around that. So again, that might be a situation where the SRA is actively providing pointers as to what's expected in terms of good practice, might start to sort of give an evidence base to assist insurers in terms of looking at practices in firms. And pricing accordingly. Mental health representation again is another area, and I think this plays into the culture sort of piece really, around what is a good culture, what does that do for the mental health of the individuals that work within it. Because we'll all be aware that if somebody has got poor mental health, suffering with mental health issues, then they're not going to be operating at their best, and therefore the likelihood of mistakes and claims is probably going to increase. So it'd be interesting as well to see what happens there. And I think that probably chimes in with the IBA report that came out recently that indicated that there is a high level of mental ill health within the legal profession, and that's globally, not just in this country. And then interestingly as well, the SRA may be looking at linking up with the legal ombudsman to assess which of the firms who are suffering, if you like, from the most number of service complaints. So it'll be interesting to see what that means in terms of outcome. Of course, if you're a big volume provider, you would probably say, well, we receive more complaints because we're dealing with more clients, or perhaps more third parties. And
but
really,
that's something that an insurer could ask to
yes,
ask to see, but certainly could be aware of and use as part of their risk rating. In the same way, I think the Land Registry said a couple of years ago now that they were going to start a league table of the firms who provided them with the most amount of headaches by getting the documentation wrong, and having to issue requisitions. And I think a lot of insurers sort of seized on that and thought, well, that would be a good little way of working out whether we're dealing with a good firm here or a bad firm if they're anywhere near the top of those league tables. But I don't think that's an idea that the Land Registry has yet taken forward. But a couple of good resources there for insurers to use if they wanted to.
Yes, absolutely. So I think those are some sort of key areas of focus.
I put AML on there as well, Amanda.
Oh yes. Well, AML it feels like now an ever-present issue for law firms, because and I think that's for a variety of reasons, but it stems from the top really. It's a key sort of government priority that the country, the UK PLC, if you like, is not seen as being a sort of facilitator for corruption, financial crime, money laundering activity, and they are putting increasing amounts of resource into making sure that they can demonstrate that they're taking it seriously. So the economic crime plan that's come out now going to impose an economic crime levy on all entities that are regulated under the money laundering regulations, which includes law firms, obviously. So they want to impose a levy on all law firms going forward to help fund the economic crime plan. They have decided that the supervisors for money laundering are not doing a good enough job and need another oversight body to look at that. So they've implemented OPBAS, which sits obviously now within the FCA, and is sort of scrutinising all of the AML supervisors, of which the SRA has the kind of practical task of implementing all of that on behalf of the Law Society. And so the SRA has, as I was mentioning before, sort of set up a whole new team of people at the SRA whose job is to scrutinise AML activity within law firms. And they've been doing a variety of things, calling in risk assessments, for example, for desk-based review, calling in procedure manuals to review, but also going out and visiting firms on site to look at their anti-money laundering compliance. So that is an area that is of increasing focus for the SRA. It's not going away anytime soon. And indeed, in the latest business plan, it's highlighted again as a key area of activity for the year ahead.
And it's amazing to me how many claims I see have got AML angles in them. You know, the dream bar fraud is a classic, isn't it? And you know, we still see examples of that fraud coming around all the time, and whether or not the right due diligence was undertaken at the time of matter opening. And it's just a very easy win for a claimant solicitor if the right processes and procedures aren't followed at the outset. And we've had to settle a lot of claims because, you know, the AML guidance is there. It's in black and white, literally. It's very easy to read, easy to follow. And if it hasn't been followed, claimants' lawyers just seize on it, and it's a very uncomfortable position to find ourselves in. So all of these things that you've been saying, Amanda, I think they all play into the sort of the claims environment that the profession is in at the moment. And how, you know, they go to explain perhaps to some extent why it is that claims activity against lawyers is on the rise. Definitely. Yeah,
I think it'll also be interesting to watch the economic situation going forward. You know, we've been in a period for a number of years now where we've had really quite low interest rates. I think if interest rates start to rise, then you'll have sort of external factors starting to play into claims as well. You know, I'm old enough to remember when I just bought my first house back in the 1992, whenever it was, the interest rates rose 3 times in a day and were then around 15%. Now, obviously, we're nowhere near that at the moment, but you can imagine now if interest rates start to rise, people start to default on their mortgages, then it could lead to another wave, if you like, of sort of mortgage fraud claims. So I think that'll be interesting to watch going forward.
Definitely. We've had a question in from Callum asking, basically saying he's curious that there might be a focus on powers of attorney and executorship as a fraud risk, and that maybe, you know, that in terms of other areas of fraud risk, you know, it seems to be a relatively minor one, and that maybe actually there are better areas for them to focus on. I don't know whether you'd agree with that, Amanda.
For the SRA to focus on?
For the SRA, yeah.
I mean, well, I think you know, you can have quite a lot of damage done by an individual solicitor who's dealing with powers of attorney or dealing with executorship. It's there can be a lot of money involved if you have somebody who's systemically raiding estates. Basically, you know, one individual can steal a lot of money, and it's obviously very personal. So it's the sort of personal harm element to it in terms of the consumer, if you like, the client suffering that when they're already in an emotional state. I think it can be very difficult, and the problem is that it's hidden. So the people who are suffering don't necessarily know that they've been stolen from. Because money can be taken out. If you're a power of attorney for somebody, you can be effectively stealing from their accounts without them knowing, without anybody else knowing. If they then die, whatever's left in their accounts then goes into the estate. So it might go undiscovered. So I think that is probably why it might seem a bit basic, but a lot of harm can result from it.
I've certainly heard anecdotally of an increased fraud risk from fraudulent clients, in inverted commas, coming to law firms claiming to be the sole beneficiary to a deceased estate and getting the firm to do all the probate and all of the work, all the while that client actually is nothing to do with the deceased at all, but they just happen to know that they've died and they're just getting in quick, and their intention is to just strip the estate of its assets and move on before the real family come forward. And because a lot of the vast majority of estates are administered remotely, as in that you don't get to meet the clients necessarily, and there is perceived to be a lower level of client checking and all of the sort of anti-fraud checks going on in that area. That's an area that the fraudsters seem to be targeting, or so I've heard, starting to target as a way of, as I say, stripping an estate of its assets before the genuine beneficiaries come forward. So it could be that that's an aspect of it as well.
Mm. I think there's a whole host of activity that happens around sort of the wills and probate sector, ranging from effectively solicitors sort of grooming people so that they are made direct gifts from a will, through to grooming people so that they become the executor, so they have that sort of literally have that work banked for the future. Through to then the sort of the ability to basically just steal out of the estates and such like. So
happy days, huh? Happy days.
Keeps the investigators busy, that's for sure.
I put personal standards up there. I think that's just something that you talked about earlier on, Amanda, about how the SRA seem to be focusing increasingly on our conduct away from the office as much as our conduct within it. There was the case very recently of the WhatsApp messages, wasn't it, where somebody was found to have sent inappropriate WhatsApp messages into a closed group, albeit the group was about 100 people, I think. Yes. But that was discovered, and I'm not sure if they were struck off or certainly sanctioned for that inappropriate use of WhatsApp. So yeah, got to be very, very careful, I think, in this day and age. The SRA are really looking at that in a much more extensive and serious way than they might have done before, and that's certainly something for you guys listening in to be speaking to your firms about, because again, that just sounds in disciplinary proceedings, which then end up costing a lot of money, time, effort, hassle, and are very easily avoided, it seems to me. And again, I guess that transitions into what perhaps you can be doing, what more you can be doing in the current market conditions, and in view of all of the pressures that we've talked about today, to make sure that your insureds are viewed most favourably by insurers and have the best opportunity to keep trading into the future despite having such huge premiums to pay. And the most obvious one of those is the way in which their risks are presented. I still see the prop forms for a lot of firms where they're just done as a bit of an afterthought, or they do a generic prop form, and a lot of insurers at the moment just won't accept those. Whilst insurance is still viewed very much as a distressed purchase by most law firms and other professionals, I think it's really key that they are sort of brought to the table kicking and screaming to do a proper job, and to really paint themselves in the most favourable light possible. Insofar as they've got historic problems, then there are various ways in which we can help to ameliorate those problems that we have here, and we have a risk audit service that can sort of provide a bit of an alternative view to what might on paper look to be a bad historic situation. So it can present all of the things that the firm has done well since that situation to sort of try and bring themselves back on to the right tracks. But there are various other ways in which firms can paint a much better view of themselves than perhaps they are at the moment. And I do think a lot of firms are perhaps not making the most of that opportunity. And I think that this is something that is going to happen increasingly over the next couple of years whilst the market continues to be in the hard cycle, is how to pay for the cover or how to get a better deal on the premiums. So I'm thinking here of things like I've heard of a lot of firms, bigger firms, looking at starting up captive arrangements so that they can not feel as if they're just paying that money into a pot that they never use. Some are collectively buying their insurance, either through partnering arrangements or networks, so the law net style model. So a lot of firms are going down that route and trying to get sort of economies of scale that way, or insuring their excesses is another one, or M&A is the other classic. I mean, as often happens in the precursor to any downward turn in the economic cycle, we see a spike in M&A activity to try and again get those economies of scale, and we're certainly seeing a lot of that at the moment. I don't know whether you, in the context of what you're seeing, the firms that you're dealing with are seeing that too, but it certainly seems to be something that's on the rise. So that, I think, was pretty much it. I mean, the only thing which I mentioned at the beginning really was the increased potential for there to be coverage issues because of the cyber PI overlap, because of split primaries, and all of the other things that seem to be coming out of the current hard market. And I think that there is a broking issue there, insofar as any of your clients have got double insurance, and the issues around whether they're paying too much for their insurance, and obviously then equally the potential for gaps in insurance. Whenever we've got these situations of multiple insurers on different lines, or crossovers between covers, it does give the potential for problems at the broking end. So definitely urge caution, and really make sure that you really understand and read the cyber cover in particular and what it is providing, and make sure your clients are fully informed of what it is that they're doing. And insofar as they decide not to buy cyber cover, make sure you've got some notes, and you really do document that, because I do foresee trouble ahead in relation to this sort of silent cyber crossover. But that, I think, subject to anything else you had to say, Amanda, I think that's pretty much all that we had to cover off today. Have you got any more points to add?
No, I don't think I have. I think we've given a good round through, and
brilliant.
We're just at 5 o'clock now.
There we go. So I think we're okay. I'm just having a look at the questions. Oh, I think we've got one question from Michael. Mentioned that cyber policies have third-party cover, but all the cyber policies taken out by solicitors firms that we've seen only cover first-party funds. Well, I think there are now some dedicated solicitors cyber policies coming through, which obviously look to dovetail the cover between the PI and the cyber. I think, are far closer to that than I am. So insofar as there isn't an overlap, or you're finding that you can secure wording that don't contain that first party, third party overlap, or the third party overlap on the cyber and the PI, then that's great. Obviously there you've got to work out whether there's any gaps in cover. But certainly in my experience of dealing with just standalone cyber policies, they do have that element typically of third-party coverage, which is really where I think most of the problems with this silent cyber debate have arisen from. But as I say, if you're not finding that, and you're just finding first-party cover for cyber, then that's tremendous. I hope that's okay. If anybody has got any questions or queries, do feel free to contact either Amanda or myself. When the materials come through, we'll have our contact details on there. I'll put the Dixon, Coles and Gill reference in there too. So other than that, have a lovely Thursday evening, and thank you very much for your time. Cheers. Bye-bye.
Bye-bye.